Hello, my name is Steve Bigelow with the Candlestick Forum. The market is in kind of a sideways downward drift, more of a downward orientation. But there are pattern breakouts that are working very well. So as we can see, after the gap down and the close below the T line, the Dow has come back to what we would perceive to be the first potential target, the 50-day moving average. Doesn't show a lot of bullish sentiment. Now you include the fact that the NASDAQ is also trading below the T line, giving you a good prospect that they could bring this back to the 50-day moving average. This is where you can utilize all the other indicators that would be pertinent, like putting on the Fibonacci retracement numbers and seeing what levels they might be heading back to. But at this point, as long as we're trading below the T line, the assumption is we should be in a downtrend. Now, that doesn't stop the patterns from working well. ATEC, you can see the fry pan bottom. You can see the breakout level. Now, this is what you have for prospects, even though the market itself may be drifting lower. Same scenario on our recommendation last week on VCIG. There's your best friend signal telling you there's a brand new investor sentiment in this stock. You can see the 45-degree in progress. These are the type that once you identify where there's been a major change of investor sentiment, the probabilities are much stronger that you're in the right direction. So there's very good specifications of if you see a breakout, when can you be buying and when do you want to be back out of the trade? This is what we kind of train people to utilize the information built into candlestick charts to see when you can continue to be buying so that you get those big price moves. Again, this identified that there was a brand new bottom, a brand new investor sentiment in this market. So these are the type of patterns you like to find because they put you in high probability situations where the bulls are in control and they'll probably stay in control. And as you know, they work just as effectively on the short side. The dumpling top, rounding slow curve, failure at the 50, close below the T line, gap down through any support level, tells you there's a lot of bearish pressure in progress. So anytime you start seeing these gap downs, especially below the T line, stochastics heading down, the probabilities remain extremely strong that the bears are in control. This is not rocket science. This is just common sense elements put into a graphic depiction that the Japanese rice traders have provided for us over 400 years. That'll be it. We'll see you in the chat rooms.